Hello friends, welcome back. Today we are going more deeper into some budgeting calculations and the logic behind budgeting calculations. We don't want to memorize the formulas for budgeting calculations. Instead of that, we should understand what is the exact logic beyond that calculations. If you try to memorize the formulas, it will be a mess for you. But instead, if you try to understand the exact formula and the logic behind that formula, it will be very useful and it can be used in your examination without any stress. Even it will be useful in your work life as well. Let's start with a small example. Imagine a grocery store owner who expects to sell 500 bottles of water next week. This is a scenario, this is a sales forecast. He want to place that order to suppliers. So before he is placing that order to supplier, he want to consider the existing stock. Total he has to sell or he will sell 500 units of a particular product. Before placing order to a supplier, he should consider the exact current stock or opening stock, plus he has to consider what could be his closing stock for that particular period. In the same example, if a 500 unit is your sales forecast and you want to add another a 250 unit should be at the ending stock for a particular period. So you have to consider this both while you are ordering. Again, is there any opening stock for that particular period that you can deduct as well? Suppose you already have opening stock of 100 unit. Suppose in this case, how much you have to order? This 500 plus 250 minus 100, that is 650 unit only you have to order. This will satisfy your ending stock requirement, plus this is consider your opening inventory as well. So this is a simple example. When it's come to practical or when it's come to the real scenarios, there will be some other factors also has to consider, like your expected price trend for that material, again your leading time. There are multiple factors also has to be considered while it's come to practical application. Now, we will move into flexible budgeting. Suppose, just take an example. If a company expected to produce 10,000 units, but actually it is produced 12,000 units. Should the management expect electricity cost to remain unchanged? No. The simple answer is no, because you expected to produce 10,000 units for a particular period and you developed your electricity budget and all other related expense budget based on that 10,000 units. But actually you produced 12,000 units. So there will be a change in all the expenses, like all the variable expenses, like your electricity expenses, your purchase budget, direct labor expenses, on all the variable expenses. So in this scenario, this organization has to use flexible budgeting instead of a static budget. It has to use flexible budgeting. So it has to adjust all the expenses, or especially the variable expenses, based on the actual production, 12,000 units, and that budget has to compare with your actual performance. Otherwise, the comparison will not be meaningful, because you budgeted your expenses based on 10,000 unit and the actual production is 12,000 unit. So you cannot compare the 10,000 unit budget with the actual 11,000 or 12,000 units production. So your budget has to be converted into 12,000 units. This process what we called as flexible budgeting. So the flexible budgeting will answer a simple question related to cost. What should cost have been actual level of activities? That means with the actual level of activities, what should be the manufacturing or other related costs. Just take another example. Suppose a delivery company estimates fuel cost $2 per delivery. If 5,000 deliveries are made, the expected fuel cost will be 10,000. If 6,000 deliveries are actually made, the management should not compare the actual fuel cost with the 10,000 because the activity level got changed. So instead of the flexible budget, instead the flexible budget should be adjusted. That means 2 into 6,000 deliveries, that is 12,000 should be your budgeted expenses. So now your benchmark become 12,000 because the activity level got changed. Okay, now let's try to understand production planning. Once you estimate your sales, now you have to understand or you have to determine how many units you should produce. A company must produce enough unit to satisfy the customer demand, plus they have to maintain desired inventory level as well. Again, they can consider or they can deduct the beginning inventory from that total quantity. Just take an example. Suppose a company expected to sell 1,000 chairs next month. This is their sales forecast. Again, the management want to have 200 chairs remaining inventory at the end of the month. So this is the ending inventory requirement, and currently 150 chairs already in the inventory. This is beginning inventory. So how much chairs the company has to produce? So it has to consider the demand, that is 1,000 plus 200, that is the required ending inventory for that particular period. So total 1,200 chairs required. Out of this 1,200, 150 chairs already exist in the stock. So that 150 you can reduce. So the final quantity to be produced is 1,050 chairs or 1,050 units of product has to be produced. Okay, now let's move into material planning or the purchase budget. Once you made your production budget, now you have to understand what is your material requirement, or you have to come into material planning. So in the material planning process, the management asks how much material needed for the production. For a particular production, how much material required. Again, how much material should remain available afterward. What should be your ending inventory of raw material for that particular period. Again, how much material is already on hand. This is the opening stock. Again, when it comes to raw material planning, you have to consider your production requirement plus the ending inventory requirement, and from the total quantity you can minus your inventory on hand or the opening inventory. For example, a company need 8,000 kg of a particular material for plant production. Management want 1,500 kg remaining at the month end. This is ending inventory, and the current inventory equal 1,000 kg. So your total requirement will be 8,000 plus 1,500, that is 9,500, minus you can reduce your existing inventory 1,000. So it should be 8,500 kg has to purchase in this case. Now let's move into inventory. The inventory principle or inventory mean which include finished product, raw material and merchandise inventory as well. That means the inventory you would bought for direct sales. For an example, a warehouse begin with a month of 5,000 500 unit. This is your beginning inventory for a particular product, and during that particular period 1200 unit were you received, or this is your purchase, and during the same month 1000 unit are sold. So at the month end, how you will calculate your ending inventory? You should take your beginning inventory plus your purchase minus your sales. So in this case, your ending inventory will be 700 unit. This is how we will calculate the ending inventory unit while it's come to inventory budgeting. Now let's move into cash budget. Cash budget is completely a different subject than the sales budget. Maybe some students, they will think that cash budget is the sales budget because the sales is generating the revenue. But when it's come to sales budget and cash budget, there are some key differences, because sales budget is to generate the revenue, but when it's come to cash budget, it's dependent on the cash collection and cash payment. When will be the cash actually received? A company can record sales today, but they receive payment weeks or month later. It can happen, especially if your company have a credit sales, you can make the sales today, but the collection will happen maybe only after several months. At the same time, the purchase can also happen the same, because the purchase can happen today, but the payment can occur in the future. Because of these timing differences, the cash budget is become very crucial, because it has to be prepared separately and it has input from various other budget like your sales budget, purchase budget, your expense budget, your capex budget. There will be various budget has to be interlinked or interconnect with the cash budget. Again, why profitable company can run out of cash? Is the profit is enough to run a company? The simple answer is no, because with the profit you can show a big amount of profit or a profitability in your profit and loss account, but when it's come to operating a company, cash is the important thing, or you should have enough cash. Suppose even some profitable companies also, some cases can have run out of cash, because if a company sell for $1 million product on credit, the income statement will show a strong profit for that particular period. However, if it is a credit sale and it is taking a time or months to collect that sales, so there can be a different story with the cash budget or cash position. So this illustrate why the cash budget has to prepare separately and why it is very crucial when it's come to budget preparation process. Now, let's try to understand cash collection. Most of the organization, in reality, they will not collect all sales immediately after the sales. Some customers pays immediately, maybe even immediately after the sales. Some will pay after 30 days, some will pay after 60 days, and some will even later. Therefore, the cash receipt depend on the collection pattern rather than sales volume alone. Definitely sales volume have a big impact on the cash collection forecast, but collection pattern also has to be considered while it's come to cash collection or cash receipt. For an example, suppose a company made sales equal to $100,000. The company expects to collect 70% collection during the month of sales and 30% to be collected in the following month. So in this example, the current month collection is only 70,000, that is 100,000 into 70%, that is 70,000 only can expect to collect current month. plus the next month collection, the balance 30,000 you have to expect to collect by next month only. So while you are preparing your cash budget, you have to consider your collection schedule or collection terms with the customer as well. Now, let's try to understand cash payments. The same thing can happen with the cash payments as well, because once you made a purchase from a supplier today, maybe you don't want to pay the supplier immediately, because most of the suppliers will offer credit terms. So suppose a business purchase $50,000 of inventory, supplier terms required to payment after only 1 month. So the current month payment is 0 and the following month payment will be 50,000. For this 50,000 you have to consider only the next month payment after once you made the purchase. Now, budget as a decision making tool. In reality, budgeting is a primary management tool which helps the management to make the various decisions. Budget will answer or help the managers to answer some important questions like, will our production capacity be sufficient? Once you compare your sales budget with your production capacity, you can understand that our current production capacity is sufficient or not. Will enough material will be available? Will staff level will be adequate? Will cash shortage occur? Will financing is required? So the budget is a management decision making tool which help the management to make various financial and strategic decisions. Without a proper budget, the managers would be forced to react to problems after they occur. If you have a proper budget, you can be proactive to your problems. If you don't have a proper budgeting system in the company, you should be reactive. Only you can act once the problem is arise. So it is a reactive approach to the problems once the problem occurs. Now, let's move into variance analysis. Variance analysis we discussed before. It is the process of comparing your actual result with your budgeted forecast. Once you prepare your budget, you have to document your budget, and the budget has to be compared with the actual result periodically to see the performance. Is there any variances or is there any deviation from the standard? It has to be addressed and corrected immediately. The variance analysis helps the management to understand what is happened, why it is happened, and whether is there any corrective actions is required. For example, suppose a sales budget for a budgeted sales were $500,000 and the actual sales were $550,000. So compared to budget, the company generated $50,000 more revenue than they expected. So in this case, the management has to determine, was this increase caused by high demand, is a higher price, or we entered into a new market, or is there any new customers, or it is our marketing success. So it has to be the management has to understand the exact reason for that variance, whether it is favorable or unfavorable, to exploit that situation or exploit into that market situations. So now just let's think as a manager. Once you have become into your professional work, you should understand, before you are doing or encountering a budget problem, you should ask yourself, what is the company trying to achieve? What is the expectation of the company? What resources are required to meet those expectations? what resources are already available in the company. What are the additional resources the company must obtain to achieve those objectives? So once you have a strategic thinker, you should try to understand before you're doing a budgeting or you're encountering with a budgeting problem, you should try to understand this situation. What are the company's expectation or what is the company's vision and mission for a particular period? What are the resources required to achieve those objectives? And what are the available resources in the company? What are the additional resources must be obtained or must be required? Before winding up this discussion, let's go through important points. First thing, budgeting calculations are based on the planning future resources requirements. Most budgeting formulas follow the logic required minus available amount. That means if you are planning your purchase, you have to consider your total requirement, that is your material requirement plus ending inventory requirement, minus you can reduce the opening inventory. Again, what is flexible budget? Which adjusts the expectation from actual level of activity for actual level of activities based on actual level of activities. Again, production planning begin with the expected sales and inventory goals. Once you have your production planning should happen with your expected sales requirement and your inventory level. Then the material planning follow the same logic. Here also you have to consider your expected material requirement plus your ending inventory requirement and you can reduce your beginning inventory. Again, the inventory increases when the items are added and decreases when the items are removed. This is about the inventory calculation or how the ending inventory is removing. Once you made more purchase, your inventory will increase. Once you outed or you sold more quantity, inventory will decrease. Again, cash budgeting. Cash budgeting is focused on cash inflow and cash outflow rather than business operations like sales and purchase. Again, when it comes to sales, the collection terms has to be considered. When it comes to purchase, your payment terms with the supplier has to be reviewed while you are preparing the cash budget. Again, the profitability and cash both are different concept and different things. Again, credit sales create timing difference between revenue recognition and cash collection. Once you made a credit sales, there will be a time difference with your revenue generation because the revenue will generate immediately after the credit sales, but the collection will happen only based on the credit terms. Again, the same things will happen with the purchase as well. When it comes to credit purchase, which will create a timing differences between purchase and cash payment. Again, budget will help the management to anticipate the future problem and to become more proactive instead of reaction. Budget variance analysis help the management to understand the difference between planned and the actual results. What is the variance analysis? It is trying to understand the difference between our expectation with the actual results. Again, budgeting is a management tool, is not an accounting exercise. Again, understanding the budgeting logic is more important, is valuable than memorizing the budgeting formulas. Again, strong budgeting skills come from understanding how organization plan and control resources. Before you are moving into budgeting, you should understand how organization plan and control the resources. So friends, if you have any doubt or you need any clarification on any of these topics, please ask me on the comment section. Thank you for watching this video.